Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar, the news and analysis you need to start the week off right in Bitcoin. Today is Monday, April 26th, and as always, we have a pretty packed show. Today, we're going to talk about the Biden administration, who is reportedly working on a regulatory framework for the crypto industry. We're also going to talk about, or compare rather, this Bitcoin market cycle to previous ones and see if we can get any insights about where we are and where we're going. And lastly, we're going to talk about the New York Fed's reverse repo facility, what that means and why that is important. So, big show today. Grab your coffees. Onto it. Now, starting as we usually do with Bitcoin, we see here that over the last 2 weeks, we've had a decent correction. This morning, we seem to be off to the races, but we're going to come back to the price in a second. Before we wanted to actually bring your attention to what we mentioned on the headline, which is the headlines that broke out last week that state that actually broke out last Monday, stating that the Biden administration is reportedly working on or in the early stages of developing a regulatory framework for the crypto industry. This can have pretty important ramifications, so we're going to keep our eyes on any future developments on this front throughout the week. But going back to the price chart, we've seen that Bitcoin has experienced a strong correction downward over the last 2 weeks, dropping a total of about 26.72% from its peak. We see that it reached a high of 64,895 and a low of 47,000, basically $47,000, almost on the dot. We see that it closed yesterday, Sunday, at 49,128, down 12.71% for the week. Now, this has not been the case for Ethereum, which, as we see, has had actually 2 very good weeks in the same time that Bitcoin has had pretty significant downwards corrections. Now, looking under the hood at some of the Bitcoin market health signals, we start to see a few divergences. So first, I wanted to bring your attention to the perpetual swaps funding rates, and we're just going to pop Deribit just to have it one of them out so that it's simpler to look at. So we see that the perpetual swap funding rates are now actually getting back to normal levels after even having slipped into negative territory over the weekend on platforms like Deribit. Again, we were looking at Deribit, and then we just went over to Kraken. A second. Yeah, so Deribit here, you can see that it was actually quite negative, or it slipped into the negative territory over the weekend. Now it's basically teetering around actually right now it's slightly negative this morning. So again, this is a healthy sign that some deleveraging has occurred in the markets. However, it's not the only indicator of leverage in the system. Let's take a look at another one. So what you have in your screen right now is the annualized rolling premium on the futures, the implied yield on the rolling 3 months futures, okay? As you can see here, it has more than halved from, highs of 46%, north of 46%, and coming down to levels of around 21.7%. So again, this has more than halved from its peak. However, we see that it's still at 21.7, and that's way, significantly above where it tends to trade. And if we draw a line here, the mean would be at around 15%. So this suggests that there still might be some more deleveraging to go, meaning we could be potentially heading lower or trading sideways for a bit longer. Now let's take a look at another important indicator, which is the Bitcoin option contracts put to call ratios. So essentially, this tracks the relationship between the put contracts, which are usually purchased to hedge the downside, and the call contracts, which are usually bought to speculate on the upside. As we can see, this index is at 77.77. It came down from 0.78 where it was yesterday. However, again, we see that this level is still significantly higher than where it typically trades. If we draw a line around this mean, it would be somewhere below the 0.7 range. So that this again suggests that there is still significant interest for investors to hedge their downside relative to the levels where it has traded over the last 12 months. So again, this is another sign of potential deleveraging or sideways action. More so than those other two, it's a sign that investors are still looking to hedge their downside. Now, what are the option markets showing us? So as of last night, which was over the weekend, these were showing, let's take away April because April ends this week. So it's not as meaningful because it has only a few days left to go in the contract. But let's look at the probabilities that the option markets are showing for Bitcoin to be above certain prices by expiration time. So over the weekend, the probability of these option contracts of Bitcoin being above $50,000 at maturity from the periods of May, June, September, and December, all of those contracts were showing probabilities that below 50% that Bitcoin would be over 50K. However, we see that with the positive price action that we're seeing this morning, these are actually moving higher. And interestingly, the May curve actually is showing a higher probability that Bitcoin is going to be over 50K than the December curve. Again, so this is interesting. The markets are essentially pricing, the option markets are essentially pricing a higher probability of Bitcoin being over 50K for May than they are for the month of, well, actually for all other subsequent months. So it's interesting that this price action, again, something to keep in mind. However, so now that we've seen some of these short-term market indicators and they don't look all too favorable, let's look at the longer picture or longer-term picture for Bitcoin, because that certainly does look favorable. And for this, in the chart that we're pulling up right now, we are, as you can see, this chart is essentially comparing this Bitcoin bull market cycle to that of the 2017 bull market cycle and that of the 2013 market cycle. So the 2021 bull market is essentially this pink line that you see in between the two. And you see that it's actually tracking the previous bull market cycles quite nicely. And the dip that we are experiencing right now seems to coincide with dips that have been experienced in previous market cycles as well. Now, where does this leave us? As you can see from the chart behind your screen, the all-time high for these two other cycles came in around 50 days, 150 days after the point in time in which we are right now. So what that translates to is that if this market were to be if this bull market cycle were to be any like the previous ones, we would be looking at a potential all-time high in this cycle in around mid-September 2021. Moving over to the S&P 500, we see that last week equity markets had a wobbly week on the back of mixed earnings and headlines around a potential new capital gains tax in the United States. However, a weaker dollar, so we can see here the dollar index actually dropped 0.86% last week. A weaker dollar during last week was almost enough for the S&P to essentially close at a new all-time high, but it was not enough. It ended up closing 0.18% lower at 4,175 points. However, we see that this morning it's already on its track to a new all-time high, it seems. For the most part, just to touch back on the corporate earnings, for the most part, corporate earnings seem to be living up to their expectations, and that is consistent with the view that asset prices, like equities, could continue rising. A very interesting signal that we saw in the markets is the fact that mortgage equity withdrawals in the US have reached 2006 levels again. And I wanted to pop this chart in the back of your screen right now. So the chart here shows US mortgage equity withdrawals in billions. And we can see that the current levels is actually right around the levels where it reached in 2006, which was right before that very big crisis that happened in the United States. Now, while this may look alarming at first glance, it's actually the behavior you'd expect from rational investors in the current environment. Americans are borrowing against the rising value of their homes to take advantage of rock-bottom interest rates and soaring property values. They are most likely using these proceeds to reinvest in hard assets like more real estate or equities, whose prices should appreciate above their borrowing costs in the coming years. For context, the rate of a 10-year mortgage in the US is about 2%, and a 30-year fixed mortgage in the US is about 3%. Consider also that the Fed has openly stated that it wants inflation to be above 2% for a considerable period of time in the future so that it averages 2% in the long run. The chart behind you, which shows dollars borrowed, does not paint the entire picture. There have been trillions of new dollars pumped into the economy, which has caused property prices to soar. A better metric to look at would be what the percentage of the property value is that homeowners have borrowed. Now, The Fed has openly stated that it does not plan to raise interest rates anytime soon. And in addition, there's a lot of cash in the system, and that puts further downward pressure on rates. The Fed is having to do some really creative adjustments to soak up the excess cash in the system and prevent banks from being tempted to lend it out at negative rates. We'll cover this in our What's Ahead section, along with some really big tech earnings that are hitting the S&P 500 and the Nasdaq this week, and those could be a big catalyst for the sector. Moving over to gold, we see that it was a flat week for gold, ending the period up 0.07% at $1,777 per ounce, and even a pretty down week for the dollar. Even a down week for the dollar, and the news that came out of China last week that it was allowing its banks to import gold in large amounts were not enough to move gold higher this last week. Now, there were no major catalysts for gold last week. However, we do have an FOMC meeting this week, and that could impact markets. We'll discuss potential implications of that in our What's Ahead section later today. Moving over to the FTX DeFi index, we see that it was a tough week for the index, actually finishing down 8.85%. Ethereum, on the other hand, finished the week up 3.58% at $2,321 per Ethereum, before touching a brand new all-time high last week of $2,645. Now, there were some news on the DeFi world this weekend and last week, and they were around this token called SafeMoon, which essentially is a coin built on top of the Binance Smart Chain. And this coin went up 4x, so it increased 4 times its original value last week, before halving to finish the week. The interesting thing here is that Binance Smart Chain continues to find ways to grab headlines and get developers to build on top of it, which is, again, they're trying to bid or they're putting in a bid, I guess, to compete against Ethereum for development talent and projects essentially to be developed on that chain. Now, a quick update on Doge, which we covered last week. We see that it had a pretty volatile week last week, closing down 14.4% after touching a high of 43 cents, essentially, and ended up closing at 26 cents, so almost halving to close the week. Moving over to our Bitcoin mining difficulty commentary, there was a lot of action last week in the mempool. After soaring last weekend and remaining congested throughout the week, the size of the mempool has come down considerably over this weekend, as you can see from the chart behind me. Transaction costs peaked at north of 250 sats per byte last week for a quick confirmation, and we're now at levels of around 60 sats per byte to be included in the next block. Now, while this is still very high, it is 4 times cheaper than it was last week. So, the next adjustment is scheduled for this coming Saturday, and should bring difficulty down another 9.5%, which should speed up the time between mined blocks and help unclog the network further. Now, as always, we leave you with what's ahead for the week. The Federal Reserve will hold its April FOMC meeting this Tuesday and Wednesday, and while the market is not necessarily expecting any major surprises, the Fed will very likely touch on the recent activity that it's seeing in the reverse repo markets. We're going to talk about what that is and why that's important very shortly. However, this week is also loaded with very important big tech earnings, which could act as a boost to the sector. Google and Microsoft report on Tuesday and are expected to report year-over-year revenue growth of 25% and 17% respectively. Apple reports on Wednesday, and data indicates that in-app spending has increased 40% in the first quarter of 2021. Facebook also reports on Wednesday, with analysts expecting a 33% increase in revenue from a year ago. And Amazon reports on Thursday, with its analysts expecting results to be 33 to 40% better than last year. Lastly, as if that weren't enough, Twitter also reports on Thursday, with its revenues expected to be 26% better than the same quarter of last year. Now, I want to pop out a chart so you guys can see something. So, the screen behind, I'll explain the chart behind me in a second, but as corporate earnings continue to impress and the dollar index seems to be picking up steam on the way down, the chart behind us by Lynn Alden is prescient. As you can see from her chart, her view is that strong earnings cycles tend to coincide with bear market cycles for the US dollar. Looking at recent indicators and price action, it does feel that we're starting to head in that direction. Bear markets for the US dollar are also tailwinds for equities, commodities, and asset prices in general. Overall, this could be a very positive backdrop for assets like Bitcoin. Perhaps this is what the Biden administration is anticipating, and why it is signaling early on that it plans to do something about capital gains taxes. These taxes only apply to investors who want to realize profits on their asset purchases by selling their assets and crystallizing their profit. As we have learned from the S&P section above, savvy investors don't sell their assets. They borrow against them to buy more assets. Borrowing from your assets is not a taxable event in most jurisdictions, and you can get liquidity to diversify your portfolio. This, among other reasons, is why investors are using up all of their debt capacity in their home investments, and also why Bitcoin-backed loans have soared in popularity this year. Now, since we've covered that, I wanted to touch on the Fed overnight repo facility, which has been getting some very interesting action as of recently. As we can see from the chart above, we are starting to see the activity pick up essentially now in April. It's a facility that does not tend to, it's very sporadic as far as when it turns on. But we're seeing that activity seems to be picking up quite fast in this part of the Fed right now. Now, what is the reverse repo market? So, just quickly, when banks have excess cash, they need somewhere to put it to work. The repo market is where banks lend cash to each other using primarily US Treasuries as collateral. This is a very active market typically. Now, there are times when there is so much cash in the system that banks will actually pay to borrow the 10-year Treasury note, to be short the 10-year Treasury note. And that creates a negative rate in the repo market. To prevent this and to discourage negative rates in the repo market, the Fed enables the New York Federal Reserve Bank to essentially lend these treasuries and take the cash at 0%. That is done to borrow the cash and take it out of the system at 0% and not have banks tempted to lend it at negative rates to each other. At a high level, you can think of the reverse repo facility of the New York Fed as that sponge that soaks up all the excess cash available and prevents it from being lent at negative rates. Now, as you can see, this facility is quickly rising and nearing the $100 billion mark. This is likely to keep growing. So, we've covered a lot today. But there's a big week coming up, and as always, we're going to keep you posted on any relevant information right here through the economic calendar and through our social media accounts at Hodl with Ledin. If you learned something today, if you enjoyed the show, I welcome you to like it, subscribe it. If you have any questions that you'd like us to cover in the next issue, I welcome you to leave it in the comments section, and we'll answer it and try to include it in our next content. If you don't yet have a Ledin account, I welcome you to check out ledin.io and see how you can start earning 6.10% APY on your first 2 Bitcoin and 12.5% APY on your USDC. Thank you, everybody. Have an excellent week, and see you next time.